Hello, everyone. So we are looking at Chapter 5, Merchandising Operations. So our learning objectives for this class is to identify the differences between service and merchandising company. We will be recording our purchases under the perpetual inventory system. We will record the sale under the perpetual inventory system. We will look at multiple step income statement. In Appendix 5A, we will be looking at calculating cost of goods sold, and under Appendix 5B, we will be looking at sales returns and sales discount under ASPE method. So getting on with Chapter 5, so the distinguishing factors between your service and the merchandising industries. So basically your service industry is where your services are provided. So something like Shaw Cable, they provide services. So the revenue is recognized once these services are provided. On the other hand, we have our merchandising companies, which are primarily your retailers, wholesalers, or your manufacturers. Your manufacturers are the guys who produce the goods. Your wholesalers are the ones who will sell in bulk, such as Costco. And your retailers are the smaller companies, such as, the retailers are the ones that sells directly to the consumers, okay? Usually the packaging is smaller, such as your Walmart or Superstore. Okay, now, when it comes to the merchandising businesses, they are selling inventory, which means they have to maintain inventory. With the servicing companies, they don't have to maintain any inventory because they are providing services. So if we remember our conversation from the prior chapters with regards to the operating cycle, at the time we were determining the operating cycle and we were looking at the longer of 1 year or the operating cycle when we were determining if our assets and liabilities were current or long-term, right? Now, what we are talking about here is actually explaining what that operating cycle means. So operating cycle is a cash to cash cycle. What that means is the time frame between the company acquiring the raw material and when those raw material or finished goods items are actually ready for sale. So the time we spent on production between raw material and finished goods, that is an operating cycle for the company. Okay, so cash to cash is another way to look at it. By the time you spend cash, up until the time you are ready to make cash by sale of those goods. Okay, so with your merchandising businesses, either they would purchase the items first, which is their inventory. Then that inventory is held into the warehouse, and finally it is sold to the customer. So that is very typical for your merchandising businesses. They are not manufacturing per se. They are only buying the items and selling it. So the income measurement process, when it comes to your revenues and expenses, your revenues come from the sales of your merchandising. For the merchandising businesses, whenever they sell any items, any products, any merchandises, that is where their revenue comes from. And in a simplest term, we refer to that as our sales revenue. Okay, now expenses is what goes with these revenues. Expenses, what we had incurred in order to produce this revenue. But expenses also are divided into two categories at this point in time. So there is a category for the cost of goods sold, and there is a category for operating expenses. Okay, so your revenue minus your expenses gives you your gross profit. So sales minus your cost of goods sold gives you your gross profit. Okay, not the operating expenses. So the general layout of your income statement in a nutshell looks like this. So we start with the sales minus our cost of goods sold gives us our gross profit. Out of that gross profit, then we deduct our operating expenses. That leaves us with income before income tax or loss, depending on what kind of expenses we had. From that, we adjust our income tax expense, and finally that leaves us our net income or a loss number. Now, because these merchandising businesses sell inventory, they have to follow some sort of an inventory system in order to track that. Now, when you look at the cost of the merchandising companies or how that cost is flowing through the inventory onto the cost of goods sold, is we take our beginning inventory plus the money we have spent on purchasing new goods. Both of them added together gives us our cost of goods that are available for sale. Out of those cost of goods sold available for sale, if we deduct our ending inventory, which is still on hand, meaning that the company hasn't sold this. So once we deduct our ending inventory, what we are left with is your cost of goods sold. So when it comes to accounting for your inventory and cost of goods sold, we look at two possible options. So the company can either use a perpetual inventory system or they can use a periodic inventory system. So a perpetual inventory system is where the company will have real-time information. So there are detailed records that are kept for the cost of each of the product that was purchased as well as sold. So in the perpetual world, the information is real-time. At any given point in time, the company will know what it has in the ending inventory, how much is it worth, how much was sold, what was purchased. All of those records are readily available at any given point in time. Okay, so it's very real-time information, which means the records get updated under the perpetual inventory system as we go. We purchase something, the records are updated right away. We sold something, records are updated again. Okay, so the physical inventory count is done at least once every year, and that is the bare minimum. The companies can do that at the end of every month, end of every quarter, or at the end of the year, whatever their preference is. But at the least, they have to do this physical count of inventory at least once a year, just to make sure that nothing is missing, and if there is, then they need to adjust their books accordingly. Okay, now the companies that do have the inventory, so such as your merchandising businesses that do have inventory, they need to make sure they have effective controls in order to make sure that their inventory asset is protected. It is an important aspect because inventory accounts make up for a very good percent of your current asset accounts. So we need to make sure there are proper internal controls that are put in place in order to protect that inventory asset. On the other end, we have our periodic inventory system. So with the periodic inventory system, the companies that follow periodic system don't recognize or don't have the need to keep ongoing records. They don't want real-time records on what was sold, what was purchased, what do I have in ending inventory. Okay, so here the records are only updated throughout at the end of the period. So throughout the period, you don't keep live information, right? So your cost of goods sold in that case is only determined at the end of the accounting period. So once the inventory count is done, and that's a bare minimum, the inventory count has to be done at least once a year. So once the inventory count is done, then our cost of goods available for sale is your beginning inventory plus the money we have spent on new purchases. Out of that, if you deduct your ending inventory, then you are left with cost of goods sold. Now, when the companies are purchasing merchandise, the purchases are recorded, and this is under the perpetual system. So under the perpetual inventory system, the companies, when they purchase anything, those purchases will become part of the inventory account. So think of your journal entry, debit the inventory account and credit cash or accounts payable. Now, what makes up the cost of that inventory? So we take the net cost of the inventory. So the money that we paid for the inventory minus any purchase returns, allowances, or discounts that we have. If you ended up returning any of those purchases, that is your returns and allowances, or if there was any discounts attached to that. So the cost of your inventory will be the net of what you paid. We will include the cost of freight. So when you're purchasing the inventory and you have to pay freight on that, that freight cost is included into your inventory. And if there are any applicable taxes, then we would include that as well. So that total of all of those elements becomes your cost of goods that you have purchased. Now, talking about your sales tax and freight, GST and HSTs, okay? So HST is your harmonized sales tax that is used in certain provinces. So these tax are not part of your cost of good. Okay, so your cost of goods does not include this because most of these costs are refundable. So if you think of your GST, the way the GST works is the companies track the GST that they have collected on the sales, and they track GST they have paid on the purchases they made. Then they net out those two numbers and the difference goes to the government. If you have paid more GST than you collected, then the government gives you a refund. Okay, so anything that is a refund that you are able to recover will not become your part of cost of goods. So same idea applies with PST because generally speaking, there is no PST on goods that are purchased for resale. But if there was, then you would include that PST cost into the cost of goods. Then comes in the concept of who is going to pay the freight. So there are a few different things here. So the only 2 points that we are focusing on with the FOB or free on board is to determine who has the title or the ownership to those goods. That is the party who will also pay the freight cost. So there are two possible ways that this can go. There can be a FOB destination and there can be FOB shipping point. So depending on the transaction, so for every transaction, if you conceptualize this, there is a buyer and there is a seller. So the question here is, who owns the good while they are in transit? Who is going to pay for those goods, for the transit cost or the transportation? Okay, that determines on what the FOB agreement is, whether we are looking at FOB destination or looking at FOB shipping point. So depending on which FOB agreement we are looking at, that determines who owns the goods and who will pay for the transit. So either seller or the buyer. Okay, so if the freight is paid by the buyer, that is FOB shipping point, then it becomes cost of merchandise purchased. So this is what your FOB destination looks like. So there is a seller. Seller is selling the goods and the buyer is buying it. So there are two parties involved in that transaction. In this case, we have FOB destination, which means that the buyer will only take possession of these goods when the goods show up at buyer's doorsteps. Okay? Which means if they are only taking possession at their doorstep, then while these goods were in transit, they become responsibility of the seller. So in this case, with FOB destination, the seller has the title to these goods. So these goods would show up on their financial statements. They have the legal title as well as the responsibility to those goods, and seller will be the party paying for freight in this case. Okay, so other way to look at that is, should something happen to these goods while they were in transit? Let's say the truck was in a rollover and all the goods were damaged. Who is going to be on the hook for those damages? Will be the seller. Okay. On the other side, we have another arrangement which is called FOB shipping point. Same idea again, seller is selling something and buyer is buying those goods. Under the FOB shipping point agreement, the buyer is agreeing to take ownership of those goods as soon as the seller loads them. Okay, as soon as they leave the seller's doorstep, those goods belong to the buyers under the FOB shipping point. So in that case, the buyer will have the legal title and ownership to these goods when they are in transit, and the buyer will be the party paying for the transit as well. So should something happen to these goods while they're in transit, under FOB shipping point, it is buyer's responsibility. Then comes our purchase returns and allowances. Now, when the companies purchase something, for any reason, at some point in time, they might want to, they go ahead and return something. Okay, whether the purchase material was out of spec, or they didn't like the color, or they had too much quantity, whatever the reason is, for any given reason, if the buyer decides to return these goods, then it becomes a purchase return and allowance. So what the seller does is, seller will either refund cash depending on the original transaction. If the buyer had originally paid cash, then the seller will refund cash when the returns happen. Okay. If the buyer had put it on the credit, then it will be a credit refund. So either way, the seller will give the refund, depends on the original transaction. The buyer can choose to keep the merchandise if the seller is willing to give an allowance. Okay, so let's say the buyer said, well, these items are out of spec. This is not the specification I gave you, and I'm going to return these goods. Now, the sellers do recognize that there will be a transit cost, there will be inconvenience, and there will be cost associated to taking these goods back. So what the seller might do is, seller might say, hey, buyer, I understand that these are out of spec. How about you keep them and I'll give you 20% discount. Okay. In that case, if the buyer decides to keep them, then it becomes a purchase allowance. It's not a return, but it's an allowance. But both of those ideas, whether that is a return or an allowance, will go to the same account. There's a single account for purchase returns and allowances. Okay, so in both of these cases, the result is going to decrease your cost of goods purchased. Then comes the discount. Now, the discounts on purchases are can play out in two different ways. One is the discount on the quantity. So the quantity discount is where they say, if you purchased 1,000 of these items, then we will give you a lump sum price. Okay, now that is not recorded separately. Okay, so that discount price is not going to be recorded separately. So the net becomes your cost of purchase. So okay, so if they said, if you buy the 1,000 quantity, we will give you these items for $500. Otherwise, it would have cost you $600. Well, the cost to the company is only $500. So your cost of goods purchased will be the net amount. So the quantity discounts are always taken net. Okay. On the other hand, there could be a purchase discount. Now, the purchase discount is when the buyer has purchased something on credit, they have to pay for that. So now, in order to expedite that payment, the seller could offer them a term for early payment. So here we have 2x10 net 30 as an example. What that means is, the buyer has an option to pay early. They don't have to. This is not a mandatory. This is purely an optional transaction. So the buyer can choose to pay early for those purchases. If they pay within 10 days of the invoice date, then they can take 2% discount on the invoice price. So they only have to pay the difference. On the other end, if the buyer chooses not to take that discount, then that 2% discount is forfeited. So outside of that 10-day discount window, so 2% is the discount, and the discount term is 10 days. Outside of that 10-day discount term, the net is 30 days. So that means this buyer has to make a payment within 30 days. So if they don't take the discount, then they have to pay 100% of the invoice price within 30 days of the invoice date. Now, because this is an option, if the buyer do choose to take the discount, then it has to be recorded separately. So the adjusting entries that we will have to do at the end of the period. Now remember, we said regardless of what method the company is following, whether they follow the perpetual system or the periodic inventory system, the company has to go through the physical inventory count at least once a year. So when that physical inventory count is done, at that point in time, if the company realizes that they do have some lower levels of inventory or the inventory is missing, we usually refer to that as shrinkage or loss or theft. Okay, so either way, if the inventory is lower than what it should be, then we adjust the difference to your cost of goods sold account. So we would debit our cost of goods sold and credit our inventory to bring that inventory account down. So this adjustment is only done once at the end of the year. Okay, but for that you do have to do your physical inventory count. So for the companies that do their physical inventory count more often, they can choose to book the shrinkage as and when they discover it. So my company, we go ahead and do our inventory count every single month. So we can account for our shrinkage every single month as well. Okay, so at the least, they will book it once a year at the end, but if they do the physical count more often, then they can adjust for shrinkage at that time. This is what our journal entries are going to look like under the perpetual inventory system from the purchaser's perspective. So when the purchaser or the buyer is buying inventory, now just as a quick reminder here, guys, the cost of inventory is the actual cost that you have paid for it, which is net of any volume discounts. Freight on the goods coming in. So when you're a buyer and you have paid freight, it is also part of your inventory account. If you have any purchase returns and purchase allowances or purchase discounts, then that is an adjustment to inventory. So your inventory cost is a net of the purchase minus purchase returns and allowances and minus purchase discount. Okay, but we will include the freight in cost. So when the inventory is purchased, we debit inventory and credit your cash or accounts payable. When we are paying freight on that, then we are increasing the cost of inventory and crediting cash. If those inventory was returned, then we would just go ahead and reverse our first journal entry there. We are debiting your cash or AP and crediting inventory account. Likewise, if you are paying within the discount period, now the buyer had a choice to take the discount. They didn't have to. Okay, if they do choose to take the discount, then they are going to debit their accounts payable for the 100% of the invoice balance, credit the inventory for the discount amount, and the remainder is your cash payment. So in the earlier example, there was a 2% discount. So let's say if it was a $100 invoice. So here the journal entry would be debit to accounts payable for $100, credit to inventory account for $2, which is your 2% discount, and cash paid out will be $98. And if, because your early payment discount is an option, if the company chooses they don't want to go with the early payment, they don't want to use the discount period, well, then they have to pay the entire account, in this case, in the last example we were looking at, within net 30 days. So at that point in time, they would have to pay 100% of the invoice total. So debit accounts payable and credit cash for $100. Then you're forfeiting the discount. Now that was as far as the purchaser was concerned under the perpetual inventory system. This is from the seller's perspective. All right. Now, again, the merchandising businesses are somebody who are buying and selling. So what we discussed up until this point is from the buyer's perspective. Now we are on the seller side. So when we are selling under the perpetual inventory system, there always are two sets of journal entries that are required. One is to record the sales. So we debit our accounts receivable and credit the sales. And the other one is to adjust our cost of goods sold on inventory system. Remember, if they are following the perpetual system, then we said this is real-time information. So with the real-time information, we are updating the cost of goods sold debit to COGS account and credit to inventory account as soon as those sales happen. That way you are adjusting your inventory so that you have correct information at any given point in time. Your sales taxes that we bill on the invoices, they are not part of your revenue account. The sales taxes have to be remitted back to the government. That is not your revenue. You are collecting that on behalf of the government, so it becomes a liability. Now, if you have freight that is FOB destination, then the seller records the cost of freight as an operating expense. So with the earlier discussion, if you were a purchaser and you had paid freight, we always took that as part of the inventory cost. But the same logic does not apply when you are selling inventory. When you're selling inventory and you had to pay freight, which is under FOB destination instance, then that is part of operating expenses. That is not an adjustment to inventory. Okay, our sales are always recorded net of discount under IFRS, and under ASPE, the sales discount are a contra account to revenue or the sales. This is what our sales transaction looks like in a nutshell. So we have our gross sales minus our contra accounts, which is sales returns and allowance, and sales discount gives us our net sales. Now this concept is covered further in accounting 3220 and 3221, but we still like to highlight this here so that you know it does exist. So under IFRS, the sales are recorded net of estimated returns. So the revenue is not recognized for the portion of sales for which the returns are anticipated. Okay, so let's say if you're thinking of Costco, there are a bunch of people who take their stuff back to Costco. So what they're saying here is Costco will not recognize all of their sales. They will have to hold on to the portion that is expected as estimated return. So they will not recognize that as revenue. Okay, so that will then become their deferred revenue or refund liability, which is type of a sales returns and allowance. An asset account, which is an estimated inventory return, is also used to record the cost of goods that are expected to be returned. So when it comes to the journal entries, this is what our journal entries will look like under the perpetual inventory system from the seller's perspective. So when we sell something, there are two sets of journal entries. So we are debiting cash or accounts receivable depending on whether the money was received today or it will be received in future. We are crediting sales, but we are keeping our refund liability separate. We are also adjusting our cost of goods sold and inventory account, but we are setting up an estimated inventory return account here. Okay, we are also adjusting our refund liability as we go against your cash or accounts receivable. So when the sales are returned by the customer, if those are in sellable condition, then we will take these items back to the inventory. If they are not in sellable condition, then we will not take them back to inventory. Okay, so if the items coming back are sellable, then we would debit our inventory account and credit our estimated inventory returns account. As a seller, when the company pays freight, then that freight cost becomes part of your operating expenses. So either a shipping expense, freight out expense, whichever way the company wants to track it, but it will be some sort of a period cost. And finally, we would collect on those accounts. So we would debit the cash and credit accounts receivable when the cash payment is received. Now, those are the examples we will be discussing in class with regards to the concepts here. Okay. Then we talk about the statement of income presentation. So your statement of income, we have already looked at one format of your statement of income so far in the earlier chapters, which was a single step statement of income. So what we are focusing on here though is your multiple step. So your multiple step will provide more details when it comes to your net income or loss. So we will be able to see the gross profit, which technically is your sales minus your cost of goods sold. Okay. Then your income from operations, which is your gross profit minus your operating expenses. And out of that, once you have your operating expenses and you have your income from operations, from that number, once we deduct our income tax expense, then we are looking at your resulting net income number. Now, the single step statement of income is not examined in this particular chapter because the focus of this chapter is on multiple step income or the statement of income. All right. So in the earlier coverage though, it could be examined, but not in this chapter. So this is what we have seen so far when we were preparing our financial statements earlier in chapter 1, 2. So your statement of income, single step looks fairly easy. We look at all of our revenues together. We look at all of our expenses together, and revenue minus expenses gives you your income before taxes. Then we deduct your income tax, and the resulting difference is your net income. But this is your multiple step income statement that we are focusing in this chapter. So the name of the financial statement, name of the statement, and for the period that it is representing. But if you look at the format, so the top half is your sales minus your cost of goods sold. That gives you your gross profit. That is calculation of your gross profit. Out of that gross profit, then we deduct all of our operating expenses. So gross profit minus operating expenses gives you income from operations. From that income from operations, we adjust the other income and expenses which are not part of your day-to-day operations. That gives you your income before income tax. Finally, adjust for the income tax expense. The resulting difference is your net income or loss. Okay, so if you're looking at the portion of the operating expenses, basically that is from your day-to-day operations. But the second half of that financial statement where you see other income and expenses, that is coming from your peripheral activities or activities that are not related to your day-to-day operations. These are the examples we will be looking at in class. Appendix 5A. So the focus of Appendix 5A is the periodic inventory system. So with the periodic inventory system, as we said earlier, what we are doing here is we are not maintaining the records in the real-time basis. The detailed records of merchandises are not kept throughout the period. So at the end of the period, when the inventory count is completed, at that point in time, we will calculate our cost of goods sold. So this part, which is Appendix 5A, covers how to calculate your cost of goods sold under the periodic inventory system. So the way to do that is we will look at our beginning inventory plus our purchases minus your ending inventory. The net difference in those is your cost of goods sold. Now, when we are comparing this to the perpetual inventory system, the differences in the recording purchases, the way the journal entries work under the perpetual and periodic inventory system are quite different. The way we record the sales is also quite different. the way, and not the way, but so much the timing of calculating the cost of goods sold is different as well. Okay, the way we calculate our cost of goods sold is the same, but the timing of when we calculate that is different. Now, just to clarify, with chapter 5, our expectation is for you to know all the journal entries with regards to perpetual inventory system from the buyer and the seller standpoint, but we are not expecting you to know the journal entries under periodic system. So this is how we are going to calculate the cost of goods sold. So your beginning inventory plus the cost of purchases. In this case, the numbers are given to you. So $36,000 of beginning inventory plus the new money the business spent on the purchases for $320,000. That gives you a total of $356,000 of goods that are available for sale. Out of the goods that were available for sale, $40,000 worth of goods are still sitting in ending inventory. Means the resulting difference must be your cost of goods sold for $316,000. That brings us to Appendix 5A, where we will be looking at sales returns under ASPE, which is accounting standards for private enterprises. So under ASPE, the sales are recorded at their full amount, and there is no estimation that we take for the sales returns that is made. The sales returns are recorded when they occur. So at that point in time, we will do two sets of journal entries. One is to recognize the reduction in sales and accounts receivable, and the other is to recognize the return of the goods to inventory and decrease in cost of goods sold. So what we're saying here is, at the beginning, when the company is recognizing their sales revenue, at that time, they don't make any allowance for these returns. As and when these allowances do come into play, they will go ahead and book two sets of journal entries at that time to adjust their sales and to take that inventory back to their inventory account and adjust their cost of goods sold. Okay, so here we can end up using a contra account for sales return. A contra account is something that's attached to a parent account and will act opposite. So the sales return will be a contra account attached to sales. So this is what our journal entries will look like under this. So on May the 8th, there is a sales returns for $300. We are crediting the accounts receivable because that accounts receivable is coming down by the same amount. So your asset is going down and shareholder equity is also coming down. On May the 8th, we are also taking this back to the inventory, assuming that these goods are in sellable condition. So we are debiting our inventory account and crediting our cost of goods sold. So your adjustment to the sales return and accounts receivable is based on the selling price, and our adjustment to inventory and cost of goods sold is based on the cost. So the effect of the inventory adjustment onto your accounting equation is your asset going up and your shareholder equity is also going up. In neither of these situations, there is any effect on your liability account. Under the ASPE, the sales are also recorded at their full amount and the sales discount is recognized when the customer pays within the discount period. Okay. So credit is to the sales discount account, which is another contra account. So basically, sales is the main parent account. So the contra account to sales is sales returns and allowance and sales discount. Okay, remember the discounts when it comes to sales discount, it is a choice. The same way with the purchase discounts, it's a choice. So if this does come into play, then we would go ahead and book the journal entry. But if it's not, the discount is not taken, then we don't have to worry about anything. So in this case, if the discount was taken for early payment, then our total accounts receivable in this case was $3,600. So we are going to credit the entire $3,600 of accounts receivable. But the sales discount out of that was $72, which is a debit to the sales discount, and resulting difference is the cash coming in. So on your statement of income, you will see an adjustment for sales discount there. So it will bring the sales value down by $72 for sales discount. These are the examples that we will cover in class with regards to this learning. And finally, here is our comparison between IFRS and ASPE about the revenue recognition, accounting for sales discount, accounting for sales returns and allowances, statement of income, and statement of comprehensive income. That is all we have for chapter 5.